Hey everybody, Josh's College Funding Hero here. I want to ask you a question right out of the gate. What do you think college is going to be like in 15 years? Because here's the thing, nobody actually knows. And that uncertainty is exactly why a lot of parents are sitting on the fence about 529 plans right now. And they're thinking, what if my kid doesn't go to college? What if they do trade school? What if an AI replaces half the jobs that require 4-year degrees and the whole higher education model just looks completely different and the economy collapses and all these different things, right? Some of these, maybe all of them, are valid questions. Today we're going to answer them. We're going to break down whether a 529 plan actually makes sense for your family, what the upsides are, the downsides, what to watch out for, and some solid alternatives if you're not sure a 529 plan is the right call. So let's dive in. First, what is a 529 plan? So, all right, real quick, what is a 529 plan? A 529 plan is basically a tax-advantaged investment account designed specifically to help you save for education expenses. Think of it like a Roth IRA, but instead of being built for retirement, it's built for college. So here's how it works in plain English. You put money into it, it grows in the market tax-free, and when you take it out for your qualified education expenses, you pay zero taxes on the gains, zero, which is a big deal. Right now, there are about 17 million 529 plan accounts in the United States, holding over $525 billion in total assets. So that's a lot of families betting on this thing. But here's a stat that's equally interesting. Only about 10% of the parents are actually using a 529 plan to save for education. So there's clearly a lot of confusion and hesitation out there about what exactly we're up to here. All right, so here are the upsides. So let's talk about why 529 plans are generally a great tool when used correctly. Upside number one is tax-free growth. So let's say hypothetically you open a 529 plan when your kid is born. You put in $200 a month for 18 years. Over that time, you've contributed about $43,000 out of pocket. So with historical stock market returns, that account could easily grow to somewhere in the range of $90,000 to $100,000 or more. And when you pull that out for college, you pay zero in federal taxes on the gains. In a regular taxable brokerage account, those gains would get hit with capital gains tax. So right there, 529 plan is already winning on a tax basis. Upside number two is many states give you a tax deduction just for contributing. So this is one a lot of people miss. In most states, we're talking about 34 states, you get either a tax deduction or a tax credit just for putting money into a 529 plan. You're not just getting tax-free growth on the back end, you're potentially getting a tax break on the front end too, so which is a double win. Every state is different, so you'll want to check what your specific state offers, but a lot of families, that state deduction alone is reason enough at least to put some money in a 529 plan each year. Upside number three, 529 plans are treated favorably for financial aid. Here's a big one. So a lot of parents say, hey Josh, I heard having a 529 plan will hurt my kids' chances of getting financial aid. And look, technically that's partially true, but it's really overstated. When colleges calculate how much financial aid your family qualifies for, they look at your assets. And yes, a 529 plan counts as an asset, but here's the key difference. 529 is owned by the parents, which it should be. Colleges can only count a maximum of 5.64% of that account balance per year. That's it. So if you got $50,000 saved in a 529 plan, the most that can impact your financial aid is about $2,800 per year, which is pretty minimal compared to the benefits of having that savings. Now compare that with a student-owned account, like a custodial account where colleges can count up to 20% of that balance. It's a huge difference. So parent-owned beats student-owned on the FAFSA every time. Upside number four, and this is a newer one, 529 plans have gotten way more flexible. So there used to be this fear that 529 plans were super rigid, use it or lose it type accounts. That's not really the case anymore. It's gotten even better recently. Under the Secure 2.0 Act, if your kid ends up not needing the money for education, you can roll it up to $35,000 from a 529 plan into a Roth IRA for the beneficiary. So completely tax-free and penalty-free. There are some rules. The account needs to have been open for 15 years and you're still subject to annual Roth IRA contribution limits. But this is a game changer because it basically eliminates the worst case scenario of overfunding. And then on top of that, the one big beautiful bill signed into law July 2025 massively expanded what you can use 529 funds for. So we're now talking K through 12 expenses like tutoring, curriculum materials, online courses, test prep fees. The K through 12 withdrawal limit is also increasing from $10,000 to $20,000 per year starting in 2026. That includes vocational school and trade programs like welding, HVAC, aviation, mechanics, cosmetology, professional credentialing, CPA exam, bar exam, licensing exams. So when people say, what if my kid doesn't go to college? Well, the 529 now covers a ton of paths that aren't traditional 4-year degrees. Again, trades, certificates, professional licenses. So it's becoming a much more flexible tool. Now the downsides. All right, so let's be honest about the downsides because this is where a lot of 529 fear comes from. So downside number one, the 10% penalty. So if you withdraw money from a 529 plan for something that doesn't qualify as an education expense, you're going to pay 10% penalty on the earnings. Not the contributions, just the earnings, but plus an ordinary income tax on those earnings. So the penalty penalty isn't catastrophic as some people make it sound, but it's still really impactful, and you need to know it's there. The good news, between the Roth IRA rollover option and the expanded list of qualified expenses, the ability to change the beneficiary to another family member, so that the odds of getting stuck with this penalty have gone down significantly, but again, it's still a real downside. Downside number 2, your investment options are limited. So unlike a regular brokerage account where you can invest in anything you want, 529 plans have a preset menu of investment options that essentially vary by state. So in a lot of states, that's perfectly fine. You got age-based index funds that automatically get more conservative as your kid gets older, which is exactly what most family needs, but you don't have the same flexibility as a full brokerage account. So downside number 3, state conformity issues. So here's a wrinkle that a lot of people miss. Some states, especially California and New York, don't always follow the federal rules when it comes to what's considered a qualified expense for state tax purposes. So while the federal government might say that you can use 529 funds for tutoring or credentialing programs, your state might not agree. And that could mean owing state taxes on that withdrawal. So you want to check your specific state rules before assuming everything that's federally qualified is also state qualified. Downside number 4, it can slightly reduce need-based financial aid. I already mentioned some of the upside. It's the same 5.64% calculation, but if financial aid is a big part of college funding strategy, that's worth knowing that having savings, including a 529 plan, can reduce your eligibility somewhat. For most families in a solid income range, need-based aid is often limited anyways, but it's still something to factor into your plan. Alternatives to a 529. So let's say you're still not totally sold on a 529 plan. What are your other options? So let's walk through a few. Alternative number 1 is a taxable joint brokerage account. This is where you just open a regular investment account in your name, jointly in the spouse's name, and invest in index funds or ETFs or stocks or whatever you want to invest in. You're not getting the tax-free growth like a 529, but you have way more flexibility. You can use the money for literally anything: college, car, a down payment on a house, whatever. No restrictions, no penalties. So it can be great if you want to incentivize your kids to do well in school. If they get a full ride, hey, we got a new car at college, things like that. The trade-off is taxes. When you sell investments in a taxable brokerage account for a gain, you're going to pay capital gains taxes. If you held the investment for more than a year, that's long-term capital gains, which are basically 0%, 15%, or 20%, depending on your income. So for a lot of the families, the brokerage account isn't as bad as it sounds from a tax perspective, but it's still not as tax efficient as a 529 when it comes to the money, when the money is actually going to education. The brokerage account also has a downside on the financial aid side. It is a student-owned account. It gets assessed at up to 20%, which is significantly worse than a parent-owned 529 plan. Alternative number 2 is a Roth IRA. This one is kind of the stealth move for college savings. So you can use a Roth IRA to pay college expenses. Because Roth IRA contributions, not earnings, just contributions, can be withdrawn at any time for any reason without penalty. It gives you some flexibility. The big upside here is that Roth IRA assets are not counted at all on the FAFSA. So if you got money sitting in an Roth IRA, it doesn't hurt you for financial aid purposes. Which is a meaningful benefit. The downside is you got annual contribution limits on a Roth IRA. In 2025, that's $7,000 if you're under 50. And there are income limits. If you make too much money, you can't contribute directly. So it's not a one-size-fits-all solution. But as a supplemental strategy, funding your Roth first, then adding a 529 plan on top of that, and that's a combination that a lot of sophisticated college savers can use. Also worth noting, if you withdraw earnings from a Roth IRA before age 59 and a half, even for college, you'll owe some income taxes on those earnings. So again, not a perfect savings vehicle, but the contribution flexibility makes it a solid complement. Alternative number 3 is custodial accounts. So these are accounts you set up for your child and the money legally becomes theirs at the age of majority, which is usually 18 or 21, depending on your state. There's no restriction on what the money can be used for, which in theory sounds great, but because of these students are student-owned accounts, they get assessed at 20% on FAFSA. So again, can significantly reduce need-based financial aid eligibility. And once the money's in there, you can't take it back. It's your kid's money legally. So if they want to spend it on something other than college, well, that's their right. Most families' custodial accounts are better suited for smaller accounts or situations where financial aid isn't a concern. Now, what about the uncertainty? Okay, so let's come back to that big question I asked at the top. So what if college looks completely different in 15 years? What if online degrees take over? What if your kid wants to be a welder or a coder who learned through YouTube? What if AI makes certain degrees worthless? Look, I get it. The future of higher education is generally uncertain. Here's how I think about it. The question isn't traditional four-year college going to survive. The question is your kid going to need some form of education or training beyond high school? And the answer to that second question is almost certainly yes. Whether that's a two-year community college, a trade certification, a coding program that qualifies, a 4-year university, or professional continuing education. Thanks to the new rules in 2025, a 529 plan now covers more than those paths than ever before. So what if they don't go to college? Fear has gotten a lot less scary. The Roth IRA rollover option means even in a true worst case scenario where your kid literally doesn't use any of it for education, you could still move up to $35,000 into their Roth IRA tax and penalty free. So you can still help set them up for success, which that's not losing money. That's just redirecting retirement savings. And honestly, between the tax-free growth, the state tax deductions, the expanded qualified expenses, and the Roth rollover backstop, the 529 plan has become one of the most well-rounded savings tools available to parents right now. I used to be a big, proponent against 529 plans, but that has definitely changed as of these new 529 changes. But that doesn't mean it's the right tool for everyone. For most families who are planning ahead for education expenses, having at least some money in a 529 plan is usually a smart move. So here's how you decide. There's a simple framework for thinking about whether a 529 plan makes sense for you, which is start with your retirement. This one's non-negotiable. Before you put a single dollar into a 529 plan, as a parent, make sure you're at least contributing to your retirement accounts, your 401k, your IRA, whatever you've got access to. You can get loans for college. You can't get student loans for retirement. Your financial security comes first. Next, check your state's tax benefits. If your state gives a deduction for 529 contributions, you should probably be contributing at least up to that deduction limit just for a free tax break, even if you have some uncertainty about whether your kid will use it. 3, think about your flexibility needs. If you're very uncertain about the path your kid will take, or if you think you might need to access that money for something else, consider splitting your savings between 529 and a taxable brokerage account or a Roth IRA. You don't have to go in on one vehicle. Next, keep it parent-owned. Whether you're using a 529 or any other savings account for college, keeping the ownership in the parent's name, not the student's name, is almost always the better call for financial aid purposes. And plan ahead. I know I say this in every video, but I'll keep saying it because it's the number one thing that separates families who navigate college funding well from those who end up scrambling. The earlier you start, the more time compound growth has to work in your favor and the more options you have. All right. So the big takeaway from today, the 529 plan is one of the most powerful and flexible college savings tools out there, especially after the 529 rule changes what's expanded and what you can use it for. Concerns about being locked in have gotten a lot less serious. A 529 plan is one of the most powerful and flexible college savings tools out there, especially after the 529 plan rules changed to expand what you can actually use it for. The concerns about having locked in have got a lot less serious, but it's not the only tool and it doesn't need to be the only tool you're using. If you want help figuring out the right mix for your family's specific situation, drop a comment below and let me know what questions you have. I read every single one. If you found this helpful, smash that like button and subscribe because we drop new college funding content every single week. As always, this is for educational purposes only. Please make sure you're talking to a qualified financial professional before making any specific decisions for your family, or reach out to us at College Funding Hero. Every situation is different. Make sure you're getting, qualified advice that directly applies to you. Until next time, cheers.